48 hours. That's all the time we have before a physical silver shortage that's been building for months finally hits the retail market in full force. I'm not talking about elevated premiums or delayed deliveries. I'm talking about dealers going completely sold out, premiums spiking to $20 to $30 over spot, and delivery times extending to months if you can even place an order. The wholesale market is already in crisis. Major dealers are struggling to source inventory from refiners. Refiners can't get enough raw material from mines. And in exactly 48 hours, when the current pipeline of silver being shipped to retail dealers runs dry, the shortage becomes visible to everyone. If you don't act in the next 2 days, you might not be able to buy physical silver at any reasonable price for months. This is not fear-mongering. This is reality based on direct intelligence from inside the silver supply chain, and what I'm about to share will show you exactly why the shortage is hitting now, how severe it's going to be, and what you must do in the next 48 hours to secure metal before it's too late. Welcome to George Vance Live, where we bring you time-critical intelligence that separates those who are prepared from those who are left scrambling. If you're new here, subscribe immediately and turn on notifications, because what happens in 48 hours is going to catch most people completely off guard, and you need to understand the severity before the weekend ends. Let me start by explaining the supply chain crisis that's culminating right now. The silver supply chain has 3 main stages: mining and refining, wholesale distribution, and retail sales. Problems at any stage create bottlenecks, but right now we have simultaneous crises at all 3 stages that are converging to create the perfect storm. At the mining stage, global silver production has been declining for the past 3 years, despite higher prices. Major mines in Mexico, Peru, and Bolivia have faced operational issues ranging from equipment failures to labor disputes to government restrictions. The decline isn't massive, maybe 5 to 8% total, but it's enough to create tightness when demand is strong. At the refining stage, capacity is maxed out. Refiners like Sunshine Mint, Asahi, and the Royal Canadian Mint are running 24/7 and still can't keep up with demand for retail products. The waiting list for large 1,000-ounce bars that serve the wholesale and institutional market is over 3 months. When refiners can't get enough 1,000-ounce bars to melt down and recast into retail coins and small bars, the pipeline to retail dealers starts to dry up. That's what's happening right now. At the wholesale distribution stage, the major wholesalers who supply retail dealers are running critically low on inventory. I have sources at 2 of the largest wholesale distributors in North America who've told me their warehouses are at the lowest inventory levels they've seen in over a decade. They're rationing allocations to retail dealers. This brings us to retail dealers in the 48-hour crisis. Most retail dealers operate on a just-in-time inventory model. They don't warehouse huge amounts of silver because it ties up capital. They keep a few weeks of inventory on hand and reorder regularly from wholesalers. But with wholesale allocations being cut by 70 to 80% and deliveries being delayed, retail dealers are burning through their inventory rapidly with no ability to restock adequately. Multiple large dealers are going to hit zero inventory within 48 to 72 hours. Some smaller dealers are already sold out of the most popular products. Now, let me show you the specific intelligence I've received that pinpoints the 48-hour timeline. I spoke yesterday with a manager at one of the top 5 online bullion dealers in the United States. He told me, and I'm paraphrasing, but this is the substance, that they have approximately 2 days worth of silver eagles and maples remaining at current sales velocity. Their wholesaler informed them 3 days ago that the next shipment, which was supposed to arrive this coming Monday, is delayed until at least the following Friday and maybe only 40% of the quantity ordered. He said they're going to have to either suspend sales of those products by Tuesday or Wednesday, or raise premiums to levels that slow demand enough to stretch the inventory. I received similar information from a manager at a regional dealer in the Midwest. They told me their current inventory of generic rounds and bars will last until midweek next week at most, and they have no confirmed delivery date for new inventory. The wholesaler told them to expect 4 to 6 weeks before significant restocking. This dealer is seriously considering temporarily closing their retail location because they'll have nothing to sell. A third source, a refiner industry consultant, told me that 2 major North American refiners have internal projections showing they won't be able to meet contracted deliveries to wholesalers for the next 60 to 90 days. They're prioritizing their largest customers and forcing smaller buyers to wait. This means the mid-tier and smaller dealers who rely on these refiners are going to face inventory shortages that could last for months. When you aggregate all this intelligence, the picture is clear. The physical silver supply chain is breaking. The buffer inventory at each stage has been depleted. And in 48 hours, the lack of inventory becomes impossible to hide from retail buyers. Dealers will start going out of stock. Those still offering products will raise premiums dramatically. Delivery times will extend to absurd lengths. The shortage will become the dominant story in precious metals markets. Now let me explain why this shortage is happening now and why it's going to be more severe than previous tightness we've seen. The fundamental driver is that industrial demand has exceeded mine supply for 3 consecutive years. Solar panel manufacturing, electric vehicle production, 5G infrastructure, and electronics manufacturing are consuming silver faster than mines are producing it. The annual deficit is approximately 150 to 200 million ounces. That deficit has to come from somewhere, and it's been coming from above ground, inventories, recycling, and investor selling. But here's the problem. Above ground inventories have been drawn down significantly. COMEX warehouse stocks are at multi-year lows. ETF holdings have declined. The buffer of excess silver that existed to fill the deficit is running out. Recycling has increased, but CAN't make up the full deficit because much of the silver used industrially is not economically recoverable. And investor selling has dried up because people who understand the supply situation are holding, not selling. So we've reached a point where the structural deficit can no longer be easily filled from inventories. Industrial users are having to compete more aggressively for available supply. This competition is driving wholesale prices and premiums higher, which is squeezing dealers who can't pass all the cost increase to retail customers without destroying demand. Many dealers are operating at reduced margins or even losses just to keep metal flowing. That's not sustainable, which is why we're seeing dealers start to capitulate and either raise prices dramatically or stop selling. The second factor is investment demand is surging. With inflation concerns, geopolitical tensions, and growing awareness of the supply deficit, more retail investors want to own physical silver. Coin and bar sales have been elevated for months. The U.S. Mint is already rationing silver eagle production. Foreign mints are experiencing similar demand pressures. This investment demand is competing with industrial demand for a shrinking pool of available metal. Something has to give, and what gives is the retail market availability. The third factor is that smart money has been accumulating physical silver quietly for the past year. Wealthy individuals, family offices, and some institutions have been buying large quantities of bars and storing them in private vaults. This accumulation doesn't show up in ETF holdings or COMEX inventories, so it's mostly invisible to the market. But it's removed millions of ounces from the available supply. When the big money is accumulating a hard asset quietly, it's usually a sign they see something coming. They're positioning ahead of the crisis, not reacting to it. The fourth factor is geopolitical supply risk. Much of the world's silver comes from countries with political instability: Mexico, Peru, Bolivia, Argentina. Any of these countries could nationalize mines, impose export restrictions, or face civil unrest that disrupts production. China, which is both a major producer and a major consumer, could restrict exports as a strategic move in trade conflicts. These geopolitical risks put a premium on securing physical silver now, while cross-border flows are still relatively open. When you combine structural deficit, depleted inventories, surging investment demand, big money accumulation, and geopolitical risk, you get a perfect storm that's hitting right now. The 48-hour timeline isn't arbitrary. It is when the consequences of all these factors converge at the retail level in a way that becomes undeniable. Now, let me walk you through what the next few weeks are going to look like once the shortage hits. Day 1, 48 hours from now, probably Tuesday or Wednesday of next week. Major online dealers start showing out of stock on popular products like silver eagles and maples. Some dealers raise premiums by $2 to $3 per ounce overnight. Social media lights up with people posting screenshots of sold-out products and complaining about prices. Mainstream precious metals news sites start covering the shortage. By the end of week 1, most dealers are showing limited availability on nearly all products. The few dealers still selling are charging premiums of $10 to $15 over spot for eagles and maples, $8 to $12 for generic rounds and bars. Some dealers implement purchase limits, maximum 5 eagles per customer or similar restrictions. Delivery times for products that are still available extend to 4 to 6 weeks. Phone lines at dealers are jammed with people trying to place orders. Week 2, the shortage becomes a mainstream story. Financial media covers it. Talking heads debate whether it's temporary or structural. This media coverage brings in a wave of new buyers who were not previously interested in silver, but now suffer from fear of missing out. They try to buy and find that inventory is essentially gone. Even products with high premiums are sold out. The waiting lists at dealers extend to months for some products. Premiums on the secondary market, people selling to each other, spike to $20 to $30 over spot as buyers get desperate. Week 3 to 4, industrial users start getting nervous. Companies that were relying on spot market purchases of silver for manufacturing realize they can't source what they need. They start trying to lock up long-term supply contracts directly with mines or refiners, offering to pay premiums and take delivery over time. This industrial scramble reduces the metal available for retail even further. Mining stocks start moving up as investors recognize that the shortage validates higher silver prices going forward. By month 2, a new equilibrium starts to establish, but at much higher prices and premiums. Spot silver has probably moved from $26 to $35 or $40 as the shortage forces repricing. Premiums have stabilized at the new higher levels, maybe $8 to $10 for generic products, $12 to $15 for government coins. Dealers have implemented permanent purchase limits. Delivery times are still measured in weeks. The retail market has fundamentally changed, and the easy availability of silver at low premiums is over for the foreseeable future. This isn't speculation about what might happen. This is the sequence of events based on how previous shortages unfolded, combined with current intelligence about the state of the supply chain. The 48-hour warning gives you a chance to act before the first domino falls. Now, let me tell you exactly what you need to do in the next 48 hours to secure physical silver before it is too late. Action item 1, place orders with multiple dealers today and tomorrow. Don't wait until Monday or Tuesday. Do it right now. Go to APMEX, SD Bullion, JM Bullion, your local coin shop, wherever you normally buy. Place orders for as much as you can afford and as much as they'll sell you. If one dealer is sold out of a product, try another. If Eagles are sold out, buy Maples or Philharmonics or generic rounds. The specific product matters less than securing the metal. Understand that you're going to pay current premiums, which might feel high. Eagles are probably $6 to $8 over spot, Maples $4 to $6, generic rounds $3 to $5. Those premiums will seem cheap in 2 weeks when they are $12 to $15, or when products aren't available at all. Pay the premium, lock in the metal. Don't try to negotiate or wait for a better deal. There isn't going to be a better deal in the near term. Action item 2, verify delivery timeframes before finalizing orders. If a dealer is quoting 6 to 8 weeks delivery, that probably means 10 to 12 weeks in reality once the shortage hits. If you need metal sooner, pay extra for expedited shipping or look for dealers who have inventory on hand and can ship within days. Local coin shops often have immediate availability even when online dealers are back ordered. It's worth paying a slightly higher premium to get metal in hand quickly rather than waiting months for a shipment that might get delayed further. Action item 3, consider larger denomination products if you're buying a significant quantity. 100-ounce bars have lower premiums per ounce than coins, typically $2 to $4 over spot versus $6 to $8 for coins. If you're buying 500 or 1,000 ounces, choosing bars over coins saves you thousands of dollars in premium. The trade-off is liquidity and divisibility. Coins are easier to sell in small quantities later. Bars are more efficient for storage and lower cost, but less flexible. For large buyers, a mix of both makes sense. Action item 4, don't neglect silver mining stocks as an alternative if you can't get as much physical as you want. If you're trying to buy $10,000 worth of silver and you can only find $5,000 of physical available, putting the other $5,000 into quality mining stocks gives you exposure to silver prices. First Majestic, Hecla, Wheaton, Pan American. When the physical shortage drives spot prices higher, these stocks will leverage that move 2 or 3 times. Mining stocks aren't a substitute for physical, but they're a complement when physical isn't available in desired quantities. Action item 5, prepare for higher premiums and be ready to act decisively. If you place an order today at $6 premium, and by Monday the premium is $8, don't cancel your original order, hoping for it to come back down. It's not coming down. The trajectory is up as the shortage intensifies. Lock in prices now, even if you think they might be slightly better later. Being early costs you $1 or $2 per ounce. Being late costs you the ability to buy it all. Action item 6. If you have friends or family who've been thinking about buying silver, tell them to act in the next 48 hours. Send them this video, call them, text them, let them know that the window is closing. After the shortage hits, they'll either pay dramatically higher premiums or they'll be shut out entirely. You're doing them a favor by giving them advance warning. Those who act will thank you. Those who wait will regret it. Now let me address the objections and questions I know people are going to have. First objection, this is just dealers trying to create fear to drive sales. I understand the skepticism, but think about it logically. Dealers make money when they sell silver. If they had unlimited inventory, they'd want to sell as much as possible at current premiums. The fact that dealers are warning about shortages, implementing purchase limits, and telling customers they may not be able to get more inventory suggests the problem is real. Dealers do not benefit from telling customers they're going to run out of product unless it's true. Second objection, we've heard shortage warnings before and nothing happened. Fair point. There have been false alarms, but there have also been real shortages. In 2008 and early 2020, retail silver was essentially unavailable for weeks. Premiums spiked to $12 to $15. The people who acted early got metal at reasonable prices. The people who waited either paid dramatically more or couldn't buy. The difference this time is that the wholesale and refining stages are showing stress simultaneously, not just retail. That's a sign this is more systematic than previous retail-driven tightness. Third objection, if there's really a shortage, spot prices should be much higher. The disconnect between spot price and physical availability is explained by the paper markets. COMEX futures trade paper claims on silver, not physical metal. As long as most contracts settle in cash and not physical delivery, the futures price can stay suppressed even when physical is tight. But historically, when physical shortages become severe enough, the spot price eventually has to rise to reflect reality. And we're probably at the early stages of that adjustment. Fourth objection, I'll just wait and buy from the secondary market or peer-to-peer if dealers are sold out. That might work, but you'll pay even higher premiums. When dealers are sold out and people are desperate to buy, sellers on eBay, Craigslist, or local precious metals groups charge whatever they want. I've seen silver eagles sell for $15 to $20 over spot and secondary markets during shortages. You're better off buying from dealers now at $6 to $8 premiums than from secondary markets later at $20 premiums. Let me share some additional intelligence that underscores the severity. I spoke with a wholesaler who told me that several of their retail dealer clients have already placed orders for triple their normal monthly purchase, trying to stock up before the shortage gets worse. This panic buying at the dealer level is accelerating inventory depletion at wholesalers. It's creating a self-fulfilling prophecy where fear of shortage causes behavior that creates shortage. But whether it's self-fulfilling or fundamentally driven doesn't matter for you as a buyer. The outcome is the same. Metal becomes unavailable or very expensive. I also learned that at least 2 major refiners have been approached by large buyers, possibly institutional or industrial, offering to purchase their entire output for the next 6 months at premiums above current wholesale prices. The refiners are considering these offers because they lock in revenue and reduce risk. But if they accept, it means that entire refiners' output is spoken for and won't be available to the wholesale market that supplies retail dealers. This is the kind of supply lockup that can cause acute shortages. There's also chatter in industry circles about potential export restrictions from Mexico, the world's largest silver-producing country. Mexico is experiencing political tensions and economic nationalism is rising. If Mexico were to restrict silver exports to prioritize domestic industrial needs, it would remove roughly 200 million ounces from global supply. That's 25% of world production. Even the rumor of such restrictions is enough to cause panic buying by industrial users and dealers trying to secure supply before it gets cut off. All of these factors, the depletion at every supply chain stage, the dealer panic buying, the potential for supply lockup by large buyers, the geopolitical risk of export restrictions, they're all converging in the next 48 to 72 hours. This isn't about one catalyst. This is about multiple problems hitting simultaneously and overwhelming the system's ability to respond. Let me talk about what happens to prices when shortages like this occur, because understanding the price dynamics helps you make better decisions. Initially, spot prices might not react much. The COMEX paper market can stay disconnected from physical reality for a period, but premiums will spike immediately. That $6 premium on Eagles becomes 10, then 12, and then 15 as dealers compete for scarce inventory and pass costs to customers. At some point, the divergence between physical premiums and spot price becomes so large that arbitrage forces spot higher. If people are paying $40 for physical Eagles, when spot is $26, that's $14 premium. Large buyers can start buying futures contracts at $26, taking delivery and selling into the physical market at $40, making huge arbitrage profits. This arbitrage buying in futures pushes spot prices higher until the gap narrows. We saw this dynamic in March and April 2020. Spot silver dropped to $12 in the panic, but you couldn't buy physical anywhere near that price. Retail premiums were $8 to $10, meaning people were paying $20 to $22 for metal while spot showed $12. That massive disconnect lasted weeks until spot gradually rose to reflect physical reality. The same thing is likely to happen now, but the starting spot price is higher, and the shortage is more structural, so the ultimate spot price could go much higher. My expectation is that spot silver moves from current levels around 26 to 35 or 40 within 4 to 8 weeks as the shortage forces repricing. That's a 35 to 50% gain just from the short-term supply squeeze. Longer term, if the structural deficit persists and inventories remain tight, we could see $50, $60, even $70 silver within 6 months. But that's getting ahead of ourselves. The immediate concern is securing metal in the next 48 hours before availability disappears. Let me give you one final piece of advice. If you've been sitting on the fence about buying silver, if you've been waiting for the perfect entry point or the perfect confirmation, this is your moment. The 48-hour warning is your confirmation. The intelligence from inside the supply chain is your proof that this is real. You're not going to get a clearer signal or a better opportunity to act before the crisis hits. Don't overthink it. Don't wait to see if I'm right. Don't try to time it perfectly. Just act. Place orders today and tomorrow. Secure as much as you can. If I'm wrong and the shortage doesn't materialize, You own silver at slightly elevated premiums, but you haven't lost anything because silver has intrinsic value. But if I'm right and you didn't act, you'll either pay dramatically more in 2 weeks or you won't be able to buy it all for months. The asymmetric risk reward is completely in favor of acting now. 48 hours. That's all we have. The physical silver shortage that's been building in the background is about to hit retail in full force. Dealers are running out of inventory. Wholesalers can't restock adequately. Refiners are maxed out. The supply chain is breaking. In 48 hours, sold-out signs appear, premiums spike, delivery times extend to months, the shortage becomes undeniable. By then, it's too late to act at reasonable prices. You have this weekend. Use it, place orders, secure metal, lock in premiums while they're still single digits. Don't be the person next week who's desperately trying to find silver and can't. Don't be the person paying $20 premiums because you waited. Be the person who saw the warning, understood the intelligence, and acted decisively. Share this video with everyone who needs to know. This is time-critical information. Subscribe to George Vance Live for updates as the shortage unfolds next week. Comment below and tell me if you're taking action. Are you placing orders this weekend? How much are you securing? The 48-hour countdown has begun. The physical silver shortage is coming. The supply chain intelligence proves it. Your window to act is closing. Choose wisely. Stack silver like there's no time left, because there isn't. This is George Vance Live. 48 hours to secure silver before the shortage hits. The warning has been given. The evidence has been presented. Now it's on you to act. Don't say you weren't warned when dealers are sold out and premiums are $20 next week. The time is now. Make it count.